Carvana, Lyft, Grubhub, GoPro, Airbnb, Snapchat. These are some of the biggest and most successful startups of the last few years. But when we say success, what does that even really mean? Because the truth is, all of these companies are technically broke. None of them are profitable. And what might be even more surprising is that the investors and VCs that fund them actually don't even want them to become profitable. I came across this article last week that showed the profitability of 73 unicorn startups. So in other words, all of these companies have a valuation of more than $1 billion. And out of all 73, only 6 of them earn a positive profit. The rest of them lose millions, hundreds of millions, and some even billions of dollars per year. And I'm sure that you're wondering why this is actually the case. And even more so, why investors actually want these startups to lose money. And most of all, I'm sure that you're wondering whether that means that you should follow suit with your startup. Well, I'm gonna tell you all these things, and we're gonna get started right now. Let's get it. So let's get back to this list, because you'll probably be just as surprised as I was with some of these. I mean, we're talking about some of the most successful and highest value tech companies ever. Now, granted, this list is from 2019, so some of these may be profitable now, but also keep in mind that even in 2019, all of these companies were valued at more than $1 billion. Carvana launched in 2012, earned revenue of $3.9 billion, and lost $114 million in 2019. And as of today, they've raised $4.8 billion in funding. I mean, would you give somebody $4.8 billion after they reported a loss of $114 million? Or how about Lyft? Back in 2019, they earned $3.6 billion in revenue, but then ended the year with a net profit of negative $2.6 billion. But prior to going public, they had raised $4.9 billion. Open Door, $4.7 billion in revenue, $339 million in losses. Wayfair, $9.1 billion in revenue, $984 million in annual losses. So just think about that. They earned $9.1 billion from sales and then spent $10 billion ending in a humongous loss. And when you actually think about these types of brands, they are literally like the epitome of success in the startup world. You see the founders on the pages of Forbes with multi-billion-dollar net worths. I mean, if you think of something like Lyft, I took 20 Lyft cars this month already. They earned at least $200 from me this month alone, and they have millions and maybe even billions of users around the globe. But actually, every time you go into the app and order a car, Lyft loses money. These brands make a ton of money, and then they spend it all plus some. And how do they fill in that gap? Well, they do that through venture capital. These brands take billions and billions of dollars from VCs, spend it all, go get some more, spend all of that, and the investors are actually happy that their money is getting spent up so fast. But for most of us, this sort of goes against everything that we know about startup valuations, about investors, and about startup funding in general. Because one of the most common valuation models is the multiple of earnings model, which assigns a multiple to the profit earned over a certain period. So for instance, SaaS businesses might value a company at 9 to 12 times a company's past 3 years profit. And relying on this model, a lot of startups go down this path, seeking to become profitable as quickly as possible. And you would think that that's what makes a company attractive to an investor.
At this current rate, we'll make $1 million.
Impressive.
And next year, we aim to make $10 million.
All right, from the $1 million in sales, what will you make? What's your profit?
I mean, if you were an investor, which one of these would you feel most comfortable putting your money in? Business A, a business that earns $885 million in revenue and then takes a $668 million net loss in the same year. Or Business B, a business that earns $50 million in revenue and keeps $20 million of that in net profit within the same year. It's no surprise that for most of us, it's going to be Business B, the one that's actually earning profit, because this business has a proven business model, a 40% profit margin, and it's really easy to see that you're going to earn a return on your investment. And if we use that same multiple of earnings formula for valuation, we will have $60 million in profit over 3 years with a 12x multiple. And that's a valuation of around $720 million. You want me to invest in that? Well, take my money. So let's look at Business A. It has a wide customer base, and its customers are spending money, obviously, because the business earned $885 million in revenue. But they lose money. Their profit margin really doesn't exist. And without my money as an investor, they would pretty much be completely turned on their heads.
A million deals in Naked City. The next guy's gonna walk in here and get my money, and he'll get rich, but not you. You are dead to me.
But for whatever reason, business A gets all the attention. Investors, they salivate over it. They overvalue it. And the media constantly talks about how successful they are, while business B just grows kind of quietly in the background. But why is this? And even more confusing is the question, how does business A, who loses $668 million a year, end up with a valuation of $32.4 billion? Just to be clear, I totally made up the B business. But business A, well, that's Doordash. And when they went public back in 2020, after losing $668 million the year before, they did so at a $102 per share trading price, which would value it at $32.4 billion. But then it actually closed its first day of trading the next day at $189.51 per share, giving it a market capitalization of $72 billion. I mean, what the actual is going on here? Well, there is a reason for this. But before I can tell you that reason, you first have to realize that there are really two different types of startups out there. First, you have the average startup, and this represents like 99% of new businesses. It's one of those businesses that have a bunch of competitors and it operates in a very competitive space, but maybe they do something a little bit better or they're faster than the most used existing solution. They have some type of competitive advantage and they serve a large market. But since it's so competitive, they have to carve their portion of that market out. They start building revenue, they strive to make profit, they pitch like 100 investors, and then they finally get a few angels to invest in them after they negotiate for weeks, trying to explain why they are worth the money that they're actually asking for. And then you have the second type of startup, and this represents like 1% of all startups. And these are the startups that are considered disruptive. And by the way, I really hate that word because it's far overused. Most startups are not actually disruptive, but something like Uber, well, that was disruptive because when Uber came out, I literally never used a taxi again. Airbnb disrupted the accommodation industry. I mean, it literally makes the hotel industry piss its pants. Fiverr disrupted the freelance industry and made it where we can get tasks done for $5 and start new projects with a single click. And that's why these are considered truly disruptive businesses that don't really have too many direct competitors. Instead, they compete against the traditional way of doing something. But instead of carving out their part of an existing market, they literally create the market and have the opportunity to take the whole thing before new competitors start coming in. And seemingly, there really is no cap to where their growth can go. Like when Netflix launched, no one knew what it could actually be in the future. Maybe their market size would be Blockbuster's market, or maybe it would end up being cable television's market, or maybe its total addressable market would be anybody who uses the internet. But the potential of these types of startups is seemingly endless. And they approach the market a little differently. They launch and they do anything they can to capture the market instantly, even if they have to do it at a loss. And they don't attend 100 investor meetings either. Investors literally line up at their door hoping to throw money at them. And since they kind of have the pick of the litter on which investors they want to take on, they can use that competition to drive up their overall valuations. If you think back to 2004 when Facebook launched, they didn't even have a monetization strategy. In 2009, they finally reached a profit after launching their ads platform. But the real draw for investors was the 400 million users that were already on the platform, spending hours of their day on there, and literally coming back every single day. And by the time Facebook actually reached profitability, they had already raised over $700 million in venture capital. And they needed it because since they didn't have a monetization strategy, they lost money every time they acquired a new user. So it wasn't profit that got them their investments, it was the potential of a profitable exit. So now you know the two types of startups, but why do investors invest in each of these? Well, it's no secret that startup A is a much safer bet. They have some validation, they have a great product, and you can easily see where they're going. They fit in a space where they can be huge private companies. One day, maybe they'll get acquired by a bigger company, and the investor will get some decent return on their investment. But in the meantime, the investors want to see profit so they can get some recurring dividends. And as the profit grows, so does the valuation of the company. And then when it's acquired, the more profit they have, well, that means the more money that they're going to earn from the sale. And then we look at startup B, which is our disruptive unicorn. For them, the goal is to get to exit and blow up the valuation as much as possible. They do this by building up the idea of potential and growing their bases to millions and millions of users, even if they have to do so at a loss. Because later on, when they go public, their valuation isn't just based on their earnings, but also on their future potential. When Uber and Lyft decided to go public, Lyft had lost $911 million in the prior year, and Uber had lost $1.8 billion, but they had significant revenue. Lyft had earned $2 billion in revenue in that same year, and Uber earned something like $48 billion. But even at a loss, experts suggested that both companies had solid core business models. They were earning a ton of cash, they had millions of users, and they both had the potential to take over the entire market. Uber literally had dozens of investors by the time they went public, and those investors knew that their money was going to be spent up quickly as Uber invested in customer acquisition and put more money into growing the platform. Profitability wasn't really important for investors. What they were looking for was a growing valuation, and the hope of exiting by IPO meant that they would significantly multiply their initial investments. Take a look at this table that shows the return on investment for Uber's seed investors. Garrett Camp put in $220,000, and he made $1.092 billion when Uber went public. Cyan and Scott Bannister put in $50,000 and got a return of $248 million. Mike Walsh, who only put in $5,000, grew his investment to $24.8 million. And that right there is the reason that investors will put their money in something that otherwise might seem like a sinking ship. It's to get to the IPO, exit, and then make 100, 500, or in the case of Mike Walsh, 4,965 times their original investment. But before your startup even gets to the point where you can attract investors, you first need to have a product that has the necessary qualities to attract them. Our team recently created an ebook called Build Your Fundable App, which walks you through everything you need to know to build an app startup that investors want to put their money into. It gives you the step-by-step process of building your product from the ideation stage, and then gives several examples of how other unicorns launch their products. And the best part is you can download it for free. I'll leave a link down in the description so you can get your copy today. When you look at these unicorn businesses and you wonder why they are so huge even though they're losing all their investors' funds, well, it's really by design. It's purposeful. They burn the money to grow because profit isn't their intent. But should you copy the same strategy? Should you be focusing on spending as much as possible to grow as fast as possible? Well, probably not. Because even if you think your startup is disruptive, by definition, it probably isn't. And if you go spending all your money and it doesn't lead to growth, well, you might not be able to find an investor to cover your losses the way that Lyft, Grubhub, Wayfair, or Carvana could. Instead, my advice to you is to always seek profit, because these unicorns represent less than 1% of all startups. And for the other 99%, it's very hard to prove that you have endless potential for success. And instead, investors will look at your profits to value your company. They will look at how well you've protected other investors' money. And they'll look at how prior investments led to financial growth. If you fit that 1%, you'll really know it immediately. Your brand will hit TechCrunch, then it'll get posted on Reddit, and then you'll have millions of people jumping on your app or buying your product, and you'll barely be able to keep up. And you'll absolutely need that investor's funding in order to hit the next level of growth, because you're already busting at the seams with customers or users. All the publications will be talking about you, investors will be calling you day and night, and new competitors will be jumping at the chance to enter the market and compete with you. If your startup doesn't fit that criteria, then you're in the 99%. And that's perfectly okay, because many entrepreneurs in that 99% ended up becoming billionaires too. But if you're just launching your startup, you really shouldn't even be thinking about chasing investors right now anyway. Instead, there's one thing that you should be focused on, and I'll tell you everything you need to know about it in this video right here. I hope you enjoyed this video, and I'll see you in the next one. Until then, take care and keep doing amazing